Hey everyone, welcome back. Today we're diving deep into something that can seriously level up your business commercial real estate financing.
Yeah, and we're not just talking about getting a loan. We're looking at how owning the right property can be a total game changer.
And we've got an awesome guidebook packed with practical advice. So whether you're a seasoned pro or just starting out, there's something here for everyone.
What's fascinating is how much this area has evolved.
Right.
I mean, we've gone from simple local deals to these crazy complex financing tools that operate on like a global scale.
It really highlights how real estate is connected to literally everything.
Oh, yeah.
Government policies, the economy, even tech, they all play a part.
And the best part is it's become way more accessible for small business owners over time.
That is good news. More options, more chances to find the perfect fit.
Right.
Okay, but before we get lost in the world of loans and interest rates, let's back up for a sec. What exactly makes commercial real estate different from, say, my apartment?
It all boils down to profit. Commercial real estate is all about generating income, either through selling the property later at a profit, like capital gains, or by leasing it out and collecting that sweet, sweet rent.
Gotcha. So within commercial properties, there's a whole range, right? Like I'm picturing massive office buildings.
Exactly. And even within office spaces, you have classifications like Class A, B, and C. These basically tell you about the building's quality, its amenities, and the location.
So Class A is like the penthouse suite of office spaces.
You got it. Top tier, high end. Class C might be more functional, more budget friendly.
Makes sense. Then there's retail, from like big shopping malls to those cool mixed-use development.
Oh, yeah, those are popping up everywhere these days.
And of course, we can't forget about those industrial powerhouses, the warehouses, factories, distribution centers.
Those are the backbone of the economy.
For sure. So we've got the types of properties,
Yeah.
but when it comes to financing them, is it as straightforward as getting a mortgage on a house?
Not quite. Commercial loans are a whole different ballgame.
How so?
For one, we're talking way larger amounts. They often have shorter terms and sometimes come with something called a balloon payment.
Okay, a balloon payment. That doesn't sound as fun as it.
Right. It basically means a big chunk of the principal is due at the end of the loan term.
Okay. So why would someone choose that?
Sometimes it's the best way to structure the deal, especially for businesses that are projected to grow a lot in the future. It can mean lower monthly payments initially, so you can invest more back into the business.
So it's a strategic move then.
Definitely.
Now, the guidebook also mentioned higher interest rates for commercial loans compared to like what I get for my house. Why is that?
Lenders see more risk with commercial properties. They're looking at the income potential of the property itself, not just your personal finances.
So they need to know the building can pay its own way.
Exactly. They need to be confident that it can generate enough cash flow to cover the loan payments.
Okay, that makes sense. So where do people even start looking for financing? Is it always through a bank?
Banks are a big player for sure, but there's a whole spectrum of financing avenues out there. Traditional bank loans are still an option, but they might not be the best fit for every situation.
What are some of the downsides?
Well, they can be a bit slow, lots of paperwork, and they often require a pretty big down payment. Plus, you're more likely to run into personal guarantees, meaning your own assets are on the line if things go south. It's a big commitment.
Got it. So what are the alternatives then? What if you need funding faster or your credit score isn't perfect?
That's where things get interesting. Have you ever heard of SBA loans?
The name rings a bell, but...
Basically, it's the government lending a hand to small businesses.
Oh,
The SBA, or Small Business Administration, has programs like the 504 and 7A loans. These are specifically designed to make commercial real estate financing more, well, attainable.
so what makes them different from a regular bank loan?
They tend to have more relaxed qualification requirements, plus they offer favorable terms. It's like the government is vouching for you, which makes lenders a little more willing to take a chance.
So even if my credit history isn't perfect, an SBA loan might still be possible.
Exactly. It's a great option for businesses that might not tick all the boxes for a traditional bank loan, but have a solid plan and potential for growth. Of course, there's still paperwork, and it might take a bit longer to process.
Government bureaucracy, right?
Right. But hey, easier qualifications and better terms sound like a pretty good trade-off to me.
Agreed. So we've got banks, SBA loans. What else is there?
A whole world of options. There are CMBS loans, which stands for Commercial Mortgage-Backed Securities.
CMBS loans. That sounds a little complicated.
It can seem that way, but it's essentially a way to access a lot more capital Think of it like your loan becoming part of a big pool of mortgages, which are bundled together and sold to investors.
So like my loan is being traded on Wall Street.
Kind of. The downside is that they can be a bit inflexible. Refinancing early or making changes can be a pain, and lenders are going to really scrutinize your business and the property itself.
Higher risk, higher reward, I guess.
It's all about finding the right fit for your situation.
So banks, SBA loans, CMBS loans, are we done with loan options yet?
Nope, not even close. We've got bridge loans, which are for short-term needs. Let's say you find the perfect property, but you need to move fast, and you don't have time to wait for a traditional loan. A bridge loan can help you make that purchase quickly.
So it's like a financial bridge to get you from point A to point B.
Exactly. You might use it while waiting for a traditional loan to be approved or to fund renovations that will increase the property's value.
But I'm guessing those come with a higher price tag, being short-term and all.
You're right, they usually have higher interest rates. The key is having a solid exit strategy. Like, how are you going to repay that loan once you secure more permanent financing?
Makes sense. Okay, what about if my credit score isn't the best? Are there options for someone like that?
Absolutely. That's where hard money loans come in. These are typically from private lenders who care more about the value of the property itself than your credit history.
So bad credit, no problem.
Well, not quite that simple. Hard money loans can be great for certain situations if you're looking to flip a property quickly, or if you're dealing with a distressed sale that a bank wouldn't touch. But they come with higher interest rates and shorter terms, so use them strategically.
It's all about weighing the risks and rewards, choosing the right tool for the job.
Exactly. And we haven't even touched on mezzanine financing, construction loans, all sorts of specialized options. There really is a solution for almost every scenario out there.
Wow, this is already a lot to process. So before we go even deeper into financing options, let's talk about why someone would even go through all this trouble. Why own instead of just renting?
That's a great question, and the answer goes beyond simply avoiding a landlord. Owning commercial real estate is a powerful way to build equity. It's wealth that grows over time as your property value goes up. Plus, there are some great tax advantages that can save you money and improve your bottom line.
Tax advantages always catch my attention. Tell me more.
For example, you can deduct things like interest payments and property taxes from your taxable income, which lowers your overall tax bill. And then there's depreciation, where you can deduct a portion of the property's value each year to account for wear and tear.
So owning can actually put more money back in my pocket.
It can, definitely. These tax benefits can be a major boost for your cash flow.
Now we're talking. But surely there are downsides to owning, right? It can't be all sunshine and roses.
Of course not. It's important to go into this with a realistic view. Owning commercial real estate comes with responsibilities and potential risks. For one, the application process can be a lot. Lots of paperwork, credit checks, appraisals. You might even need to hire professionals to help you navigate everything.
That sounds like a lot of hurdles to clear. And what about qualifying? Is it harder than getting a mortgage for a house?
It can be, yeah. Lenders have strict requirements for commercial real estate loans. They want to see a good credit history, proof you can manage debt, and a clear plan for how the property will help your business succeed.
So it's not just about buying any building. It's about finding one that makes strategic sense.
You got it.
What other downsides should I be aware of?
Well, let's not forget about defaulting on the loan. With commercial real estate, it can be way more severe than with a home mortgage. You could face foreclosure much faster, and remember those personal guarantees. Those could put your personal assets at risk.
Yikes. Okay, noted. What about flexibility? What if my business needs change down the line?
That's another factor to keep in mind. Repayment schedules are usually fixed, and prepayment penalties can really bite if you need to sell the property or refinance early. So think long-term, make sure this property aligns with where your business is headed.
Okay, so before I even think about filling out an application, how do I know if this is even the right move for my business? What does the ideal candidate look like?
Well, ideally, you have an established business with a history of profitability.
Okay.
A strong credit history is a must, and you need a clear plan for how this property will contribute to your growth.
So if my business depends on foot traffic, owning a prime retail spot could be huge.
Exactly. Or if you're a manufacturer, having your own facility could give you a real edge. It's about making the property work for you.
So there's no one-size-fits-all answer. The decision to buy really depends on the specific business and its goals.
Precisely. And it's more than just the building itself. It's about how owning the right property can become a strategic asset, something that takes your business to that next level.
Love that. So let's say I've done my homework, weighed the pros and cons, and I'm ready to take the plunge.
Right.
What are those first steps?
Well, usually you'd start by getting pre-qualified for a loan. This gives you an idea of how much you can borrow so you can narrow your property search and show sellers you're serious.
And then comes the application process with all that paperwork.
Exactly. You'll need things like financial statements, tax returns, a solid business plan, basically, a complete picture of your financial health and how viable your project is.
And that's where understanding those interest rates and fees comes in. Even a small difference can make a big impact over time.
Absolutely. And that's what we'll be diving into in the next part of our deep dive.
Sounds like we've got a lot more to unpack.
We do. We'll break down those interest rates, explain those tricky fees, and give you the tools you need to negotiate the best possible deal.
Can't wait. See you all in part 2.